Everyone watching this right now wants the same answer. Is the SpaceX IPO actually the opportunity of a lifetime, or is it one of the biggest financial traps ever created? Because over the next few weeks, something massive is about to happen in the stock market, and whether you plan on buying SpaceX or not, there's a very good chance you're still going to end up owning it. That's the part nobody's really talking about. This isn't just another flashy IPO with Elon Musk tweeting rocket emojis while Wall Street celebrates. This is potentially the largest public offering in history, and the deeper you look into it, the stranger the entire thing starts to become. At a reported target valuation of around $1.75 trillion, SpaceX would instantly become one of the most valuable companies on Earth. To put that into perspective, that valuation would make it worth more than every American defense contractor combined. More than Coca-Cola, McDonald's, Disney, Nike, and Starbucks combined. More than the 10 biggest companies listed on the London Stock Exchange combined. And the obvious question becomes, who is actually buying a company at that kind of valuation when it reportedly lost nearly $5 billion last year? The answer is probably you. Not directly, maybe. You might never open Robinhood and manually buy a single share. But if you have retirement money sitting in index funds, ETFs, pension funds, or basically any passive investment vehicle tied to American equities, there's a good chance your money is going to end up flowing into SpaceX automatically. And the reason that matters is because the rules that make that possible were quietly changed right before this IPO. But before getting into that part, you first have to understand what SpaceX actually is. Because most people still think SpaceX is a rocket company. Ask random people on the street and they'll probably say rockets, Mars missions, NASA launches, astronauts, explosions, maybe memes about Dogecoin somehow ending up on the moon. But that's not really the business anymore. SpaceX today is actually 3 different companies stacked together under one giant valuation, and only one of those businesses is carrying the financial weight of the entire operation. There's the exciting part people see, there's the profitable part investors care about, and then there's the part that honestly looks like it could become a financial black hole. And the weirdest part is that the weakest business inside SpaceX is somehow valued like it's the future of civilization. A huge piece of this story starts with Xi. Most people know it as Elon Musk's artificial intelligence company, but it's also tied directly to the platform formerly known as Twitter, now called X. Elon launched Xi in 2023 as a competitor to OpenAI and Anthropic, and only a short time later, SpaceX absorbed Xi through an all-stock merger that valued the combined entity at around $1.25 trillion, with Xi itself supposedly worth about $250 billion, which immediately raises an uncomfortable question. How exactly does one Elon Musk company buy another Elon Musk company at a $250 billion valuation determined mostly by Elon Musk? Nobody really seems to have a clean answer for that, but the deal happened anyway. And here's where things get messy. You would assume a company valued at $250 billion would at least be generating serious revenue, or showing strong profitability, or maybe keeping its founding team intact. But none of that appears to be true. Xi launched with an elite roster of engineers and researchers pulled from places like DeepMind, OpenAI, Google, and the University of Toronto. It looked like a legitimate heavyweight AI startup. Then, the spending exploded. By 2025, reports suggested the company was burning through more than $1 billion every month. And by March of this year, every single one of the original 11 co-founders had reportedly left the company. Then Elon himself publicly admitted on X that the company needed to be rebuilt from the ground up, which is an unbelievable thing to hear considering SpaceX effectively paid $250 billion for it. And financially, the numbers become even harder to justify. OpenAI reportedly generates around $24 billion annually and carries a valuation around $850 billion. Anthropic reportedly generates over $30 billion annually with a valuation around $400 billion. Meanwhile, Xi is estimated to generate maybe around $1 billion in annual revenue, yet somehow carries a $250 billion valuation. That's not aggressive pricing. That's something closer to fantasy level pricing. It's like valuing a regional airline as if it were Emirates. And that matters because Xi isn't helping fund SpaceX. It's draining it. While the rest of the business is generating real cash flow, Xi appears to be consuming enormous amounts of capital at an almost unbelievable pace. Which brings us to the second business inside SpaceX, the one everyone thinks is the main event. The rocket division. This is the side of SpaceX that launches satellites into orbit, sends cargo missions to the International Space Station, handles contracts with NASA, and conducts military launches for the US government. It's the business that built the company's reputation. It's the side people associate with innovation and engineering breakthroughs. And to be fair, the rocket business is genuinely impressive. But financially, it's not carrying a $1.75 trillion valuation. The rocket operations reportedly generated around $4 billion in revenue last year. That sounds huge until you compare it to the valuation attached to the company. Suddenly, the numbers start looking surprisingly small, especially once you realize the rocket business accounted for only around a quarter of SpaceX's total revenue, which means the real engine inside SpaceX is something entirely different. Starlink. This is the business investors actually care about. Starlink is essentially satellite internet delivered from space. Thousands of satellites orbiting Earth beam internet directly to customer terminals sitting on rooftops across the world. It sounds ridiculous until you realize it actually works unbelievably well, and the growth has been absurd. Starlink launched publicly only a few years ago, yet it has already become one of the fastest scaling telecom businesses ever created. There are now more than 10,000 Starlink satellites in orbit. Millions of customers across roughly 150 countries use the service. Commercial airlines are integrating it. Ships and yachts are using maritime versions. Military contracts have expanded through classified defense systems connected to Starshield. And unlike the AI division, this business actually prints money. In 2025 alone, Starlink reportedly generated around $11.4 billion in revenue, making up the majority of SpaceX's total business. But the really shocking part isn't just the revenue. It's the margins. A couple years ago, Starlink's margins reportedly sat around 41%. Now they're supposedly around 63%. That kind of margin expansion over such a short period is almost unheard of in telecom infrastructure. Which means the strongest part of SpaceX is not rockets at all, it's internet infrastructure. And this is why the company becomes so difficult to value, because investors aren't really buying a rocket company. They're buying a telecom giant mixed with a speculative AI lab wrapped inside one of the most culturally influential brands on Earth. But when you combine all three businesses together, the numbers stop looking nearly as clean. It allowed time for proper price discovery before passive index funds were forced to start buying the stock. But now that waiting period has been reduced dramatically. Instead of 3 months, companies can now enter after only 15 trading days. That means billions of dollars tied to passive funds can start flowing into a stock almost immediately after the IPO. But that's only one of the changes. Previously, companies also needed a minimum public float requirement. At least 10% of shares had to actually trade publicly in order to qualify for index inclusion. SpaceX reportedly plans to float only around 4 to 5% of the company. Under the old rules, that would have disqualified them automatically. Under the new rules, suddenly it works. And then comes the strangest adjustment of all. Buried inside the technical details is effectively a weighting multiplier. Companies with public floats under 20% can now have those floats treated as if they're 3 times larger than reality for index weighting purposes, meaning if SpaceX only floats 4% publicly, index systems may effectively treat it more like 12%. Think about what that does mechanically. SpaceX is reportedly targeting closer to 30%. That is enormous. And according to comments made by SpaceX CFO Brett Johnson, retail participation is expected to play a critical role in the offering because retail investors have been extremely supportive of Elon Musk over the years. Translated into plain English, one of the biggest IPOs ever created intends to rely heavily on ordinary investors emotionally attached to Elon Musk and the SpaceX brand. And this is where the entire structure starts looking uncomfortable. Because the buyers arrive first, the insiders sell later, passive funds absorb shares automatically, retirement accounts become forced participants. And eventually, the shares held cheaply by insiders move into the hands of index investors buying at historically extreme valuations. That's why portfolio manager George Noble described the situation so bluntly when he said your 401k becomes the exit liquidity. Because for millions of people, that's exactly what may happen. You won't vote on it. You won't choose it. The system will simply buy it for you because that's how passive investing works. And this is the part traditional financial media struggles to explain clearly because the simpler headline is always more exciting. SpaceX goes public at $1.75 trillion sounds futuristic and thrilling. NASDAQ quietly rewrites index rules before massive IPO sounds technical and boring. But the second headline is probably the more important one, because passive investing was sold as the smartest long-term strategy ever created. Low fees, diversification, automated investing, no emotional stock picking, just buy the market and let time do the work. And for the most part, that strategy has worked incredibly well. But hidden inside that convenience is something people rarely think about. Passive investing doesn't ask questions. It doesn't evaluate valuations emotionally. It doesn't debate whether a company is overpriced. It simply buys whatever enters the index. Which means if someone figures out how to engineer their way into those indexes under favorable conditions, trillions of dollars can begin flowing toward them automatically. And right now, it looks like somebody just figured out exactly how to do that.